Less than a quarter after buying into the stock, billionaire investor Bill Ackman has sold out of Netflix, and this was pretty surprising news, but it came after some pretty surprising earnings. In this video, I'm going to do an intrinsic value analysis on Netflix using a discounted cash flow model. But as always, all of my videos should not be used as specific advice for your portfolio because everyone's risk tolerance is different, your assumptions may be very different. So if you need help with your portfolio, go and speak with a licensed financial professional, because I am not one of those. But without further ado, let's try and figure out what exactly is going on with Netflix stock and what's going on with the business. As we can see based on the chart, Netflix stock has seen better days. Actually, if we go to the year-to-date view, it looks even worse, down 64% since the beginning of this year. So a really crazy drop for a company that used to be over, if we go back to a 5-year view, it got as high as about $660 per share, all the way down to $215 per share, at least as of this filming. By the time the market opens, when this video releases, we'll see if the price changes anymore, because they've had a couple of very significant drops just in this first quarter or so of the year. They had a major drop following their earnings report in January, followed by another major drop, this in their most recent earnings just a few days ago. And it doesn't look like investors are enjoying this roller coaster on the way down. Based on their current stock price, that would put them at a valuation of around $97 billion or so. So still a very major sized company, a very big company in market cap terms, even after the major drop. And before we get into some of the details of their most recent earnings, let's go ahead and take a look at the financial situation for the company and try and see what we're working with here. So let's head on over to the financials and go to the balance sheet to see what they're working with. I usually like to start with the balance sheet, specifically their cash. It looks like they have about $6 billion in cash and short-term investments with really no short-term investments. So that's all cash. And if we actually look at the last 12 months, that includes their most recent earnings. So still about $6 billion in cash. And if we go ahead and compare that to their debt, going down here to see how indebted they are, they have about $14.5 billion in long-term debt and about $2.5 billion in capitalized leases. So we'll round it up to about $17 billion in longer-term debt compared to their cash balance of only about $6 billion. So you would like to see them have more cash than debt, but that's usually not the case for a lot of companies. So it's not the end of the world because it very much depends on their cash flow and how they're actually generating cash beyond what they already have on their balance sheet. But one other thing I like to look at on the balance sheet is the total shares outstanding to see if the shareholders are being diluted at all. And it looks like we have seen some dilution over the last few years, but not a whole lot, especially given that they are technically a growth company, or they were considered a growth company. That might be changing now given their recent earnings. But anyways, you're not seeing a ton of dilution. And what I mean by dilution is when a company issues new shares so that existing shareholders now have a lesser share of the overarching business. And the way that works is there are now more shares outstanding, but existing investors still have the same amount of shares as before. So they now have been diluted in their ownership of the company. The opposite of this would be share buybacks, where the company is actually repurchasing its own shares so that existing shareholders then get a greater share of the overarching business despite not actually buying any more stock themselves. But in any event, at least in recent years, you haven't seen a ton of either or with Netflix. There were some rumblings that they would be doing more share repurchases in the future, but we're not seeing that at this point, and we haven't seen much dilution recently either, so I guess that's a good thing. So that's the balance sheet. Let's go ahead and take a look at the income statement to see what kind of money they're bringing in. Hey everyone, real quick, check out the M1 Finance affiliate link in the description below. It's a free to use brokerage. It's one of my favorites. I have a whole series dedicated to my M1 Finance portfolio that I do updates on every single month, so definitely check that out. I'll link to it below. It's a really easy to use brokerage with some pretty nice features, including some very cheap margin loans if you're into that sort of thing, as well as a great user interface and the ability to do auto investing as well and auto rebalancing your portfolio, at least assuming you care about portfolio allocation in the first place. Anyways, check out the link to M1 Finance in the description below, and if you end up funding your account, I might get a small commission, which would go a long way towards helping the channel. Anyways, let's get back to it. Look at the top line here for revenues. They brought in about $30.5 billion in the last 12 months, and that's pretty consistent with the last year. And if we compare that to the last few years, they have been able to grow revenues at a very substantial clip, looking at something like 30 to mid-20% growth every single year. And it has slowed a bit as they continue to get larger and larger. It becomes harder to grow once you hit a certain point. $30 billion is a lot of money. So bringing in 30% more on top of that when your basis is that much bigger, that is a tough thing to do. So keep that in mind as companies grow. Eventually, there is a limit to the amount of growth they can keep up. And it seems like investors might be noticing that right now with Netflix. But if we take a look at this as a graph, you can see just a straight line up, or at least it has been for the past few years. And the thing about a lot of these growthier companies is investors seem to think that this growth rate will just continue forever and forever, and they'll maintain that 30% clip forever, and it just grows to encompass the entire economy. At least that's the way it seems sometimes. But that is not how it works out in reality. Eventually, the company will slow down. The question is, when will they slow down, and for how long will they slow down? Will they be able to pick things up again? Will they have to pivot or adjust in some way? All sorts of different considerations for as to how to get that growth rate back up, and that's the challenge of business. But in general, the top line really has not been the problem for Netflix. It's continued to grow and grow, and even if it has slowed a bit compared to the last few years, it still maintains a pretty substantial growth rate, all things considered. And their gross margins have actually expanded over the last few years, which is not very common to see, especially once you get up to this size. Typically, as revenues increase and the total addressable market becomes more and more saturated, or as they get a greater and greater share, it becomes more expensive to get another customer, or it becomes more expensive because there are more competitors. So you have to cut your prices or something like that. So your margins get decreased. You're actually seeing the opposite with Netflix. As they've grown, their gross margins have also grown. But that might be a bit misleading because they are spending a ton of money on content, which makes sense given the industry they're in. But ultimately, we're just looking at the top line here. And I always like to look at the free cash flow of the business. So to see what that is, we're going to have to go over to the cash flow statement. And to get free cash flow, let me remove revenues from this chart here. We go down to cash from operations and subtract capital expenditures. And this ends up being your free cash flow when you subtract these numbers. And what's left over is what the company can use to buy back shares, issue dividends, reinvest back into the business, and all the great stuff that you like to see businesses do. And you'll notice, at least over the past 5 years, Netflix has only had one positive year of free cash flow, and that was in 2020, where they made about $2 billion in free cash flow. So a pretty nice year compared to the last few years where they had some pretty significant negative free cash flow. And if we go to 2021, they were back into the negative, albeit a much smaller loss compared to some of these other years. And they were negative, $150 million or so. If we move down to the last 12 months, that doesn't actually show on the chart. They are at almost break even from a free cash flow perspective, about $564 million in CapEx spending versus their $540 million or so in cash from operations. So slightly negative. Now, if you're paying real close attention, you might have noticed this line item here that's used to calculate cash from operations, and that is other operating activities. And this includes their spend on creating new content. Very big part of the Netflix business is creating new content, be it movies, shows, and just replenishing, replacing, creating new growth content, whatever it is for different markets as well. That's all factored in here. And you'll notice that this spend has continued to rise as the company continues to grow, which does make some sense. They are still trying to get into new markets and create more and more content, especially in this new environment that they're in, where there's so many competitors entering the streaming space, and very worthy competitors at that. It's not as though they're dealing with small little producers. We're talking about the likes of Disney, Hulu, Amazon, among many others that are entering this streaming space. And maybe that was accelerated by the pandemic and all the great things that brought, but it did bring a lot of pressure to the streaming space and a lot of pressure to create streaming products. So Netflix has felt that pressure, of course. Every single streaming service has felt that pressure to try and get as much content out as more people are looking for new media options. But we can see this spending graphically, and you can see that it has continued to mount, and they're up to about $17 billion or so, at least in 2021, that they spent towards content versus about the same number, which is consistent with their last 12 months at just under $18 billion in other operating activities, which would include their content spend. Now, a huge question here with this spending is how much of it is for growing the business versus how much of it is for maintaining business. There's obviously going to be a lot of churn with any media-oriented business. Once someone sees a show that they wanted to see, are they going to stay on the platform? That's one of the hardest parts of the entertainment business. It's keeping people on the platform. And if someone sees a show or the few shows that they wanted to see and they leave the platform, there goes a paying customer. So you got to keep putting new content in front of them or better content in front of them. And that is how you keep them on the platform, ideally. So there's always going to be some amount of spending to maintain customers customers in a business like this. The question is, how much do they really need to spend? I personally think this is both the most important question and probably the hardest question to answer for Netflix, is how much of this really is going towards growth versus how much is going just to maintain their existing business, because that's going to determine your ultimate profitability, because it's one of the largest expenses, if not the largest single expense for Netflix as a company. And that brings us to what's going on with Netflix now, because there are some significant red flags that have scared away a lot of investors, Bill Ackman included. We'll get back to him in a moment. But let's take a look at their most recent earnings letter, where they summarize some of what's going on and what they think is going to be happening in the near future. We zoom in here, we can see, right, to start off this letter, our revenue growth has slowed considerably as our results and forecasts below show. Streaming is winning over linear as we predicted, and Netflix titles are very popular globally. They still are bringing in many billions of dollars for content, obviously, so they're doing well in that sense. However, our relatively high household penetration, which including the large number of household sharing accounts, combined with competition, is creating revenue growth headwinds. So they're starting to feel the pressure. Moving on down the letter, we can go to this growth section here, where they outline a few factors that they think are pretty big headwinds heading into the future, the near future right now. First, it's increasingly clear that the pace of our growth into our underlying addressable market is partly dependent on factors we don't directly control, like the uptake of connected TVs, the adoption of on-demand entertainment, and data costs. So stuff that they can't really control, and they're kind of depending on that to keep improving over time. There's not much they can really do about it in the grand scheme of things. Second, in addition to our 222 million paying households, we estimate that Netflix is being shared with over 100 million additional households. Account sharing as a percentage of our paying membership hasn't changed much over the years, but coupled with the first factor means it's harder to grow membership in many markets, an issue that was obscured by our COVID growth, which was accelerated compared to what they might have expected. Third, competition for viewing with linear TV as well as YouTube, Amazon, and Hulu has been robust for the last 15 years. However, over the last 3 years, as traditional entertainment companies realize streaming is the future, many new streaming services have also launched. In other words, the competition is picking up, and they kind of show this graphically. There are some more major competitors coming in here that are taking significant chunks of market share, although Netflix remains one of the leaders. Fourth, macro factors, including sluggish economic growth, increasing inflation, geopolitical events such as Russia's invasion of Ukraine, and some continued disruption from COVID are likely having an impact as well. Apparently, they actually lost a number of users from the Russian conflict, which is no good for Netflix. It's really no good for anyone, but that has affected their business, and they expect it to affect them moving forward. One thing they do focus on in this article is that they want to focus on how to best monetize sharing. So the 100 million households that they mentioned that are basically mooching off of other paying households, they are looking for ways to try and monetize that, maybe adding advertisements or paid sharing features or something like that to try and tap into this sort of untapped revenue source that you wonder how much that's going to affect the amount of people using the platform. Well, you get a lot of people leaving if they're no longer able to share with their friends and family, which a lot of people do. So that's obviously a big sort of question mark. Is this going to hurt the business? Are they going to be able to capitalize this in an effective way despite all the mounting competition that might not be doing this sort of thing? So it's definitely a red flag, though it could be a potential big revenue source at the same time. But they do emphasize that over the long term, much of our growth will come from outside the US. Traditionally, US entertainment companies have viewed international as an export market for US content, but we saw long ago that great stories can be made anywhere and loved everywhere. So they're making new content in different countries for different countries. So that's going to be a big part of their future spending. And that would probably be considered much more on the growth side of their content spend rather than the maintenance side. This is tapping into new markets where they might not have really had tailored content for that particular market, but now they would. Moving on down to some of the near-term forecast, they mentioned that paid net additions, so the amount of people actually paying for Netflix, actually fell by about 200,000 on net compared to their initial guidance forecast of 2.5 to 4 million in the same quarter last year. So significantly underperforming compared to what they might have expected. And they said that the winding down of all Russian paid memberships resulted in a negative 700,000 impact on paid net ads. So a significant loss right there. And looking forward to next quarter, they're forecasting paid net additions of negative 2 million. So they're expecting millions of people, or millions of households, I suppose, to stop using Netflix. So a substantial net loss in subscribers compared to very consistent growth that they've had over the last however many years. That is not something you want to see from a company you might have expected to grow in a big way. And you know what that means?
Hell is coming.
That's right. That brings us to Pershing Square, run by our very own Bill Ackman, who recently bought into Netflix just at the end of January of this same year, yet he has already sold out of Netflix coming off of these very poor earnings that were quite unexpected, clearly, for both Pershing Square and many other investors. So let's take a look at Bill Ackman and Pershing Square's rationale in this short letter here as to why they sold out of Netflix, because this is probably what a lot of investors are thinking. Getting right into it, they say that in light of the enormous operating leverage inherent in the company's business model, changes in the company's future subscriber growth can have an outsized impact on our estimate of intrinsic value. So I think they were very caught off guard by the actual negative subscriber growth or the subscriber shrinkage that they're now facing. They're also nervous about how Netflix is planning to modify its subscription-only model to be more aggressive in going after non-paying customers, those sort of tag-along households, the 100 million or so major potential revenue source, sure, but that creates some uncertainty. Is this going to work? Is this going to drive people away? And it's a whole different ballgame, incorporating advertising, an approach that management estimates would take 1 to 2 years to implement. While we believe these business model changes are sensible, it's extremely difficult to predict their impact on the company's long-term subscriber growth, future revenues, operating margins, and capital intensity. In another word, uncertainty. And that's something that Pershing Square does not like as a fund. We require a high degree of predictability in the businesses in which we invest due to the highly concentrated nature of our portfolio. Pershing Square only has a handful of holdings. So in light of recent events, we've lost confidence in our ability to predict the company's future prospects with a sufficient degree of certainty. So they've decided to abandon ship despite only making the investment a few months back. And that was an investment of something like $1 to $1.1 billion that they lost about $400 million on. So that's a lot of money to lose in a pretty short period of time, and they locked in that loss. As a Pershing Square shareholder myself, I have some mixed emotions here, though. I personally didn't think that the move made a ton of sense when they first made it. And if we actually go back to their letter right here, I have it right here. This is when they first invested back in January. They were talking about how great it was, how they have enormous future growth potential, how they have economies of scale and superb quality in its content. They have pricing power, which is interesting that as soon as Netflix goes to try and exercise its pricing power, that's now viewed as a red flag. So okay, substantial margin expansion with the opportunity for continued improvement due to economies of scale and the company's rapidly growing global subscriber base. I guess they weren't expecting them to try and tap into the tag-along market of people who are getting a free ride with Netflix. But I guess Bill Ackman and Pershing Square thought that the investment was more predictable at the time, and now it isn't, which I guess is fair. I don't think many people expected negative growth, especially now, but they were emphasizing the highly recurring revenues, adding to that sort of predictability narrative that Bill Ackman always tries to go for, at least that he says he tries to go for, which to me didn't make a ton of sense with Netflix because they really haven't had a lot of free cash flow growth, which is something also that Bill Ackman goes for. He likes seeing that predictable free cash flow, which they really have not had. So it was kind of a weird move in my personal opinion, but hey, there are many ways to make money in the stock market. They did think they were buying into an improving cash flow profile, which would allow for continued growth and all that great stuff, but I guess it wasn't enough to keep them on board after this hiccup. I suppose we'll see if this is actually a hiccup or if it's going to really become something much worse for Netflix. So finally, this brings us to this discounted cash flow model for Netflix to try and figure out what an intrinsic value might be for Netflix based on a variety of assumptions. And you'll see that this looks a little bit weird right now. We'll make some adjustments, but that's because they have negative free cash flow. But just as our base case, we have a 10% growth rate for the next 5 years, followed by a 5% growth rate in free cash flow for the next 5. So it's a 10-year analysis. We're using a 15% discount rate, which is sort of like a minimum return metric in that I would expect to make more than 15% per year annualized based on this discount rate if I were to get it at the appropriate intrinsic value price. But anyways, that's used to discount all of your assumptions. So the bigger the discount rate, the more you're discounting the future, and thus the better deal you'd have to get today. Using a terminal multiple of free cash flow of 15, so you'd multiply the year 10 multiple by this number to get the sort of ending terminal value of the business. And as we explored earlier, they have negative free cash flow, so our year 0 free cash flow is negative. We'll tinker with this in just a second. And then their excess capital number takes their cash minus their long-term debt, and I realize this number is actually incorrect. They had about $6 billion in cash minus about $17 billion in long-term debt. So we're looking at negative $11 billion in excess capital. And if we were to enter this into our free cash flow model, we start with our year 0 free cash flow, grow it by our applicable growth rate, which would actually mean it's shrinking because you're growing a negative number. We would then discount all of those assumptions here using our discount rate. We'd multiply our year 10 cash flow by the terminal multiple right here, which would get us a terminal value of negative $830 million, which doesn't make any sense. But anyways, we then add up all of our discounted cash flows to get a present value of future cash flows of negative $410 million. And then if we subtract or add our excess capital, which is also a negative number, that would imply that the intrinsic value is negative 11 billion, which would mean that this is a horrible deal. You wouldn't want to pay any price for this. You'd actually want to take money. But that's using a very simplistic analysis. Obviously, this model would assume that the company never gets to positive free cash flow, which doesn't really work for a discounted cash flow model. So now we get to this game of trying to figure out what their future free cash flows are going to be, especially given their current content spend. How much of that is maintenance? How much of that is growth? How much are they going to continue to grow by? There's a lot of question marks here, and they're big question marks that are going to fundamentally change this analysis in a very huge way. I'm going to go ahead and manually plug in some cash flows here rather than using these growth rates, since we're starting with a negative number. And let's say in this next year, it maintains that negative number. So they're not making any cash flow or making slightly negative cash flow over the next year, which certainly doesn't seem like they're going to be in a great position if they're losing subscribers and they're worried about how to drive new revenue growth. But anyways, we'll say that they maintain that sort of slightly negative clip. But then in maybe, we'll call it 2 years' time, they suddenly stop some of their content spend. Maybe they grow a little bit, or at least they're starting to slow down their sort of growth mode and are trying to reap the reward of actually getting all of the subscribers and getting them onto the platform. And we'll say they get up to, I don't know, $1 billion in free cash flow. And then after that, we'll say they get to 2 billion. They double it from there. Maybe they add another billion here. They're slowing down that content spend. People are staying on the platform. They have some new ways to make revenue because they're limiting the amount of ways people can share content, something like that. You can imagine some scenarios. Maybe it gets up to $6 billion and they kind of stabilize there, grows a few percent per year after that. Still looks pretty expensive in that case. And they're getting up to almost $10 billion in free cash flow, which would imply that the company is still very overvalued if you're using these assumptions. But some people would be a lot more bullish on Netflix. Maybe they think that this number can get to $10 billion per year or something like that. Still looking pretty expensive. So the longer we'd have to wait for these free cash flows to grow, the better deal we're going to need up front for the company, because the future is risky and there are things you can do with your money in the meantime to try and drive more returns. That's really what this discount rate is getting at. Maybe they grow free cash flows by 20% per year after that or something like that, $2 billion per year in free cash flow growth. Now we're getting somewhere closer. That would imply that at the end of year 10, they're getting to close to $20 billion in free cash flow. That would be very significant, especially compared to their current numbers. But is it possible? Sure, it could be. And then you're getting much closer to a good deal. So really what I'm getting at here is this is extremely hard to value. It's very hard to say what the future is going to hold for Netflix because there's just not a lot of history to go off of. But that's one of the challenges of investing in a company that relies on future growth. You need stuff to go right, and that's very hard to predict in many cases. Who knows what's really going to happen here in the whole streaming space? There are so many competitors right now entering it, some big name competitors that Netflix is going toe-to-toe with. They're acknowledging that it's become a challenge, and that's probably not going to get any easier anytime soon. It might have some troubles growing their subscriber base or growing the revenues from their existing subscriber base. Lots of different things could go wrong for Netflix. Lots of things could go right as well, and that's where your upside would be, but you got to get it for a good price. But for me personally, I'm not particularly excited even at these otherwise depressed prices for Netflix. It's come down quite a bit, but I just need to see some more proof that they can be cash flow positive, that how much of this spend is for maintenance versus actually growing the company. It's very hard to tell in my personal opinion. You might disagree. You might have a sort of edge in this space. It's not something that I'm too comfortable with yet. So I really wouldn't want to invest in it at this point, though you could certainly make an argument that it's a pretty good deal at these prices, depending on what your future growth assumptions are for the company. I definitely would love to get your thoughts in the comments below. But otherwise, if you like this video, definitely like it since that would help the channel out a lot, and be sure to subscribe for future updates. But until next time, take care.